right. Well, with that, let's turn the spotlight on the big headline that came in on Friday evening. It was a very positive headline. GDP numbers for the first quarter coming in at a much higher than expected. The number finally that came through was 7.8%. Most estimates were ranging between 6.5% to about 6.8%. So to talk about this and to figure out how to understand and interpret this big number, we have with us Pranjul Bhandari, Chief India Economist at HSBC, and Sameer Narang, Head Economics Research Group at ICICI Bank. Pranjul and Sameer, thank you so much for joining in. So, we were just speaking to Lata about this, and we understand that, yes, there was a deflator issue at play because inflation is so low, whether you're looking at CPI or WPI, so therefore the deflator is low, so the number optically looks higher. But my point is, I think everybody knew this, right? And economists would have baked this into the estimates, and yet the beat is almost a 1% beat. 100 basis points beat above most of the consensus estimates. So, Pranjul, let's open with you. I mean, X of the technical implication, what is your assessment, or what does this number tell us in terms of the actual growth and buoyancy in the economy?
Yeah, thank you very much. So look, our forecast was just north of 7%, but not as high as 7.8%. There is a deflator issue out there, and we have tried to quantify it. I think it has overstated both industry and services. Our census by about 1 percentage points. So if we shave that off, our census real GDP growth number is closer to 6.8%. and not 7.8% that was announced. And even this 6.8% number, is a strong number. India's potential growth, its ability to grow is about 6.5%. So if you have a number which is higher than that, that's actually a good number. And there were a few good things that happened in the quarter. I think consumption was strong, both government and private sector. The government, both center and state, have front-loaded some of the expenditure. And when I look at consumers, I'm finding that there has been some increase in the informal sector. Look, at the end of the day, with oil prices falling, inflation falling, purchasing power rising, rains being good, my sense is that the rural India and the informal part of urban India have actually been beneficiaries. And I think that did show up in the number. So I think it's safe to say right now that on the eve of the 50% tariff, actually India's growth was pretty decent, close to about 6.8% when we take off the deflator boost.
Got that. Pranjul, good morning. Sameer, good morning. Sameer, your first thoughts in terms of what you made of the numbers and what have you done to your own estimates post this beat?
I agree with Pranjul. Deflator had a role to play. Also, the fact that both center and states have front-loaded their capex by quite a bit. So if you put them both together, both center and states in aggregate spent around 3.8 lakh crores in the quarter, and nominal GDP is around 87 lakh crores. So, a number in excess of 40% there implies almost a 2 percentage point boost to growth just because of front-loaded government capex. Over the next few quarters, this boost will not be there because for the year, the government is likely to spend around 10% on capex in the year. So in the subsequent quarters, you're likely to see much lower government capex, and that is likely to impinge on growth, along with lower exports, which have been weak in general, apart from exports to the US. So in aggregate, what we have done to our estimates, given this macro backdrop, is that we revised our estimate to 6.6% from 6.3% earlier. For the next 3 quarters, growth will be 6.5 or thereabouts, or 6.7 in Q2, but then it averages around 6% in H2. So for the year, number is around 6.6. Not a bad number given the global backdrop.
Pranjul, what does this do to rate cuts? I mean, a second rate cut in October, chances of that?
Look, my sense is that RBI is going to continue to cut at this point of time, given the growth drag that comes from the 50% tariff. But it may not happen as soon as October. I myself have it penciled in for December. And the reason is that by the time we have the October policy meeting, we won't get a lot of the slowdown data. Most of the slowdown is going to happen in September, and the data will start trickling in from the middle of October. So on the 1st of October, when the RBI meets, it may not actually have all the data available to claim that this is a growth slowdown and, they're going to be cutting rates. So I think we'll have to wait for a little longer. And I think that is what, in a way, the bond market is fearing at this point of time. The fact that, there is no easing, which is in the horizon very soon.
All right, got that, Pranjul. Sameer, coming across to you, what are your expectations with regard to the RBI? We are thumping the table. Yes, the Q1 print was good, but then it doesn't give us, from an equity market perspective, maybe that rate cut that people were sniffing may not come about. How do you expect the RBI to move going ahead?
No, I think, Nigel, I agree. Our view is that we don't expect a rate cut in this financial year anymore. Basis what is happening on the growth front, number one, in Q1. And in H2, though we expect growth to slow down, but it's largely driven by exports. Domestic economy, because of the GST rationalization and the proposed cut, will see a big rebound in consumption. Particularly from September 22nd onwards, when the new rates will be applicable and the Navratras start. So we believe a bumper Diwali ahead, and that would make sure that RBI holds back on the growth front, because domestic economy should be doing well. And on the second part is that we do expect inflation also to pick up. Our numbers are pretty much in line with the RBI's at 4.5% for March quarter and 5% for the next year, Q1. So overall, we expect inflation around 4.7%, but with GST rejig, it could be 20 basis points lower than that. So 4.5% is where we see next year's inflation. On back of that, we do not see RBI cutting rates in this financial year.
All right, Sameer, what about the second quarter? If I look at the trends, whether I look at the movement of cement via rail or the auto sales as well, that's likely to take a temporary hit, because of wait for clarity on the GST rates. So that's when the near term we'll like to see some kind of pausing in terms of purchases. So Q2, do you think will be an absolute washout?
No, Nigel, we don't think so, because July has been a good month. Manufacturing growth is around 5.4% that the number came in. August also should be okay, because the impact of the tariffs will be felt in September. And by end September, we expect the domestic economy to be humming by 22nd of September. So maybe 3 to 4 weeks, there could be somewhat of a lull. But I think there will be an inventory stocking ahead of the festive season, when demand should be much more than normal because of the GST rejig. So overall, we believe for the quarter, we should be around 6.5%, if not more. And the deflator will play a bigger role even in the next quarter, when WPI is actually running negative right now.
Okay. And Sameer, you said for the full year, FY26, you're at 6.6% GDP growth estimate, right?
Yes.
Okay. Pranjul, same question to you. I mean, your growth expectations for the full year, how do the final numbers now stack up? And what are your expectations from festive season? Clearly, Sameer is very, very optimistic. He's saying it's going to be a bumper Diwali, and it'll probably help mitigate the tariff impact as well. But your thoughts on the way the GST cut will play out through the economy?
Yeah, I think there's going to be a big difference between growth on the ground and official GDP numbers. And I think that's going to keep the markets a little confused. My sense is growth on the ground for the FY26 fiscal year will be about 6.3%. But the official numbers, because of the deflator problems, could be closer to 7%. It could be like 6.8% or so. And I think we have to live with this at this point of time, that there are going to be two vastly differing numbers and two vastly differing sentiments around GDP in the economy. In terms of how growth feels in the next couple of months, I'm going to agree with Sameer that July and August looked pretty good. So we were good on the eve of the 50% tariff. But I think September is going to be very weak, not only because new export orders are likely to fall, but also we're going to see some of the postponement of GST purchases. Beyond that, some of the fiscal spending may also come off, because a lot of state governments have front-loaded spending. So I would say that we could see some softness on the ground for several reasons in the next couple of months. Will GST help? On the margin, it could. But there's one thing I'm going to look out very closely. Is it going to be revenue neutral or not? Because if it's not going to be revenue neutral, it means that rate cuts in some items will be compensated by rate hikes in some other items. And then we have to be very careful. Is the net impact going to be positive or not? So we'll wait for this in the next couple of days. I think there are important GST meetings. But for me, the one thing to watch out is it revenue neutral or not?
Oh, very extremely valid point out there, Pranjul. So we'll have to keep an eye out with regard to clarity on that. But final question to you, Pranjul, before we let you go. What about the Indian rupee? Post the S&P upgrade, one would have expected, some kind of cooling off in the yields, bond yields. That hasn't really happened. The rupee as well has slipped. What's the trajectory? Because money market is the lead indicator, right? And, that was looking a little bit weakish. So what levels are you working with out there?
Well, look, at the end of the day, if you have exports to the US falling quite a bit, the trade deficit will widen. And we're already seeing that capital inflows have not been very strong. We have net FDI, which is not growing at a particularly impressive rate, and portfolio inflows are uncertain. So all of this, makes it very uncertain on how the rupee might behave, going ahead. So I think we'll have to work with the weakness that we are seeing at this point of time. In terms of bond yields, look, my sense is that if fiscal can broadly remain in check, if GST is broadly revenue neutral, inflation is low, I think RBI is going to cut more. The sentiment should overall turn positive at this point, at some point, but it's not now. Right now, I think there's this big risk aversion across all asset classes, which is dragging down, everything, equity markets, the rupee, and rates. But I think once the dust settles, I would imagine some parts of the bond yield will start looking attractive again.
All right, Pranjul, Samir, we will continue this conversation and continue to ask you as things develop, right? I mean, as both of you agree, the impact of these tariffs, of course, will take some time to show up, but show up they will, unless, of course, something gets worked out very, very quickly, and these additional 25% tariffs go away. Thanks, both of you, for being here on the program.